China isn't facing one crisis, it's facing 7 at the same time. A property collapse, bank stress, local debt spiraling out of control, a shrinking population, a pension system heading toward failure, a workforce aging fast, and an export engine that's starting to stall. This is what collapse looks like in a superpower. Not one explosion, but 7 systems breaking together, each one accelerating the next. China's population is already shrinking. Over 310 million people are now over 60, and fertility has fallen to around 1.0 births per woman. That means the future is getting smaller, while the bills get bigger. And by 2026, those 7 crises may collide into something China can't contain. Let's break down what's failing and why it's all happening at once. The crisis most people aren't paying attention to is the one that's already locked in. China's population is shrinking, not in some distant future, now. In 2025, only 7.92 million babies were born across the entire country, the lowest number since 1949. That's roughly half the births China was averaging just a decade ago. A nation of 1.4 billion people, and fewer babies born than in some mid-sized countries. Deaths now outnumber births. For the first time since the catastrophic famines of the 1960s, China's population is contracting. The fertility rate has collapsed to around 1.0 births per woman, among the lowest in the world, far below the 2.1 replacement rate needed just to keep the population stable. Beijing saw this coming and panicked. They abandoned the one-child policy, first allowing 2 children, then 3, then basically begging couples to have more babies. But Chinese couples aren't listening. They can't afford to. Raising a child in Shanghai or Beijing costs a fortune. Housing prices have eaten entire paychecks for years. Add in education expenses, healthcare, elderly care for aging parents, and suddenly having even one child feels like financial suicide. Many young Chinese are opting out entirely, and the government's incentives aren't working. Cash bonuses for newborns, extended maternity leave. None of it moves the needle. Meanwhile, the other end of the demographic scale is exploding. Over 310 million Chinese are now over 60 years old. That's roughly 1 in 5 people, and that share is climbing relentlessly every single year. Life expectancy has risen into the late 70s. People are living longer after retirement, but there aren't enough young workers to replace them. China's working-age population peaked around 2015. Since then, it's been declining. Every year, fewer workers. Every year, more retirees. The math is brutal, and you can already see the effects. Kindergartens across China are closing by the thousands. In 2023 alone, enrollment dropped by over 11%. Entire schools are shutting down. Empty classrooms, silent playgrounds. This foreshadows smaller cohorts advancing through the system. Fewer teenagers, fewer workers, fewer consumers. Industries built around families are collapsing. Baby products, education services, even real estate, because who needs new housing when fewer families are forming? And here's the kicker. There's no quick fix. Even if birth rates miraculously doubled tomorrow, those babies wouldn't become workers for 2 decades. China doesn't have 2 decades, because this demographic collapse is already breaking the system that's supposed to take care of the elderly. China's pension system was built for a young, growing population. Millions of workers paying in, fewer retirees taking out. That model worked for a while, but now it's in free fall. China runs a pay-as-you-go pension scheme. Current workers fund current retirees. It's a Ponzi scheme that only works if you have way more workers than retirees. China doesn't. The worker-to-retiree ratio is plummeting. In 2022, roughly 5 workers for every retiree. By 2040, it could be less than 3. And in 2020, the system hit a catastrophic milestone. Pension payouts exceeded contributions for the first time. The pension fund started bleeding money. Beijing had to tap reserve funds just to cover monthly payments, and those reserves are running out fast. By some estimates, the National Pension Fund for urban employees could be exhausted by 2035. Gone. Empty. But recent recalculations suggest insolvency could arrive even sooner, maybe 2030, maybe earlier. The Chinese Academy of Social Sciences warned that without major reforms, the fund could hit zero as early as the early 2030s. Nobody knows for sure because local governments have been quietly draining pension funds to cover other expenses. Some provinces are already struggling to send out checks. In poorer regions, retirees have shown up at government offices demanding their payments. Officials have taken emergency loans just to keep the system limping along. In some cases, pensions have been delayed by weeks. The central government keeps promising the state will cover shortfalls. Don't worry, they say. We'll make sure you get paid. But even yuan funneled into pensions is a yuan not spent on infrastructure or stimulus, and the gap keeps widening. To stop the bleeding, Beijing finally started raising the retirement age in 2025. Men will gradually retire at 63 instead of 60. Women later, at 55 or 58 depending on the job. The idea is to keep people working longer, contributing more, drawing less. But it's a band-aid on a gunshot wound. Many older workers can't stay productive into their mid-60s. Companies don't want to pay them. And young people watching this unfold have stopped believing they'll ever see a pension themselves. So they're saving more, spending less, which drags down consumer demand, which slows the economy, which makes the pension crisis even worse. It's a vicious cycle, and it's feeding directly into the next disaster. While Beijing scrambles to patch the safety net, the entire economy is unraveling. Start with the factories. China's industrial heartland, the workshops of the world, is in decline. Industrial profits have been sliding for years. In 2023, profits at China's large industrial firms fell 2.3%. That might not sound catastrophic, but this is China, a country built on relentless industrial growth. By late 2025, overall industrial earnings were flat, barely positive. In some sectors, deeply negative. Heavy industries like steel and cement are drowning in overcapacity. Too many blast furnaces, too many cement plants, not enough demand. Steel mills that once ran 24/7 are now operating at half capacity. Cement factories are mothballing production lines. The raw materials sector saw profits crater even harder. Factory output growth, which used to hit 10% annually in the 2000s, has collapsed to just a few percentage points. In some months, it's negative. Industrial production is actually contracting. Producer prices, what factories charge for goods, have been falling for months. That's deflation in the industrial economy. Companies are slashing prices just to move inventory. But when you cut prices, you squeeze margins. And when margins disappear, so do profits. And where profits go, jobs follow. Chinese factories aren't hiring anymore. Many are shedding workers, laying people off quietly. Youth unemployment has been a disaster. Urban unemployment for 16 to 24-year-olds hit record highs above 20% in 2023. 1 in 5 young people couldn't find work. The government was so embarrassed they stopped publishing the data in August 2023. Just stopped. But the jobs aren't coming back. Factories are automating or closing. The service sector isn't picking up the slack fast enough. In the rust belts of northeast China, in industrial hubs along the Pearl River, the pain is palpable. Layoffs, reduced shifts, shuttered plants. The social contract, work harder, get ahead, is fracturing. And then there's the export crisis. For decades, China's growth was turbocharged by exports. The world bought Chinese goods. Factories hummed. Workers had jobs. Not anymore. Worldwide demand for Chinese products is collapsing. Key markets like the United States and Europe have slowed. Supply chains are shifting to Southeast Asia and India due to trade wars. By late 2025, China's exports were flagging badly. In some months, export volumes were down nearly 10% compared to the year before. Export orders have been in continuous decline for months. Factories have fewer orders coming in. The pain is everywhere. Consumer electronics, textiles, machinery, all down. China's exports to the United States fell by double digits year over year in 2025. Even shipments to Asia, once a bright spot, have lost momentum. You can see it in the ports. Shanghai and Ningbo, massive container hubs, have seen throughput growth slow dramatically. Some months, they're handling fewer containers than the year before. In Guangdong, Jiangsu, Zhejiang, the big export manufacturing provinces, electricity consumption by industry has plateaued. Factories running below capacity. Truck drivers hauling goods to ports complain of fewer trips. Less cargo, less money. The export engine that once powered China through every crisis is sputtering out, and without that backstop, there's nothing to catch the economy as it falls. But the real devastation is happening in people's homes. For years, Chinese families believed in one thing above all else: real estate. Buy an apartment, watch the value rise, build wealth, secure your future, pass it to your children. That belief is dead. China's property market is in freefall, and it's taking household wealth down with it. New home sales have plunged. Potential buyers either can't afford apartments or have lost faith that prices will keep rising. Why buy now when prices might be lower next month? At the same time, millions of existing homeowners are trying to sell before values crater even further. The result is a historic glut. By late 2025, around 6.5 million second-hand homes were listed for sale nationwide. That's a 60% jump from just a few years earlier. 6.5 million. To put that in perspective, that's more homes for sale than the entire housing stock of some countries. Supply is wildly exceeding demand. In dozens of cities across China, unsold inventory is so massive it would take years, possibly decades, to absorb even with decent demand. Empty apartment blocks dot the skyline. Some newly built, their windows still covered in protective film. Some never fully completed, skeletal frames against the sky. Entire residential complexes stand empty. No lights at night, no cars in the parking lots. Ghost buildings in ghost districts. And property developers are collapsing. Evergrande, once Asia's largest developer, defaulted on over $300 billion in liabilities. Country Garden, another titan, also teetered into default. These were giants, companies that built entire cities. Now they're being dismantled. Their collapse sent shockwaves through global financial markets. Investors who bought their bonds lost billions. Contractors who built their buildings went unpaid. Families who bought apartments in unfinished projects were left with shells. No plumbing, no electricity, just concrete boxes. Other developers still standing have slashed new projects to almost nothing. They're focused on finishing buildings that have already sold to anxious buyers. Real estate investment, once a key driver of China's GDP, has turned deeply negative. And the government is desperate. Beijing has unleashed wave after wave of rescue policies. Interest rates slashed, mortgage terms eased, down payment requirements lowered. But the most revealing move is this: local governments and state-owned enterprises have been ordered to buy unsold homes directly from distressed developers. They're using special loans from state banks to purchase excess inventory. The plan is to convert these apartments into affordable housing or rentals. Anything to clear the glut. In some cities, officials are even offering subsidies to encourage people to move from old apartments into brand new units, just to reduce the number of empty buildings. None of it is working. Home prices keep falling. In late 2025, resale home prices were dropping at the fastest pace in over a year. Even in Shanghai and Shenzhen, where demand is usually resilient, prices fell month after month. Chinese families are watching their wealth evaporate. Real estate accounts for over 70% of household assets in China. When housing values crater, entire life savings disappear. And the pain is spreading. Because housing isn't just where families store wealth, it's the collateral behind countless loans in the banking system. When real estate crashes, banks start to buckle. China's banks, particularly the smaller ones, are under severe stress. For years, city commercial banks and rural lenders fueled China's boom by lending aggressively to property developers and local governments. Easy money, fast growth, sky-high returns. Now those bets are going catastrophically bad. Developers are defaulting. Homebuyers are refusing to pay mortgages on unfinished apartments. Why pay for a home that doesn't exist? And banks are drowning in non-performing loans. Officially, bad loan ratios are climbing, but the real number is much higher when you include special mention loans, debts at serious risk of default. By some estimates, the true stressed asset ratio for Chinese banks could be 5% or higher. On trillions of yuan in loans, that's catastrophic. To prepare for the wave of defaults, banks have dramatically increased their loss provisions. They've set aside 50% more capital compared to 2020. That's not a precaution, it's a warning sign, and funding is getting harder. Weaker banks are struggling to borrow money from other banks in the interbank market. Other lenders don't trust them. They're worried these banks might not be able to pay them back. Savers are growing worried too. They're pulling deposits, moving money to larger, safer, state-owned banks. In recent years, several rural banks suffered full-blown bank runs. Lines of depositors stretched out the door, people demanding their money back, panic spreading on social media. Authorities stepped in, sometimes with police, to freeze accounts and contain the runs. In at least one case, protesters trying to withdraw their savings were met with violence. The bank runs were contained, but trust has been shattered. If you're a Chinese saver with money in a small local bank, you're terrified right now. And then there's the shadow banking collapse. For years, trust companies and wealth management funds promised Chinese investors high returns by investing in real estate projects and local government schemes. 8%, 10%, even 12% annual returns, way higher than bank deposits. These weren't officially guaranteed, but investors believed the government would never let them fail. It was an implicit guarantee. That guarantee is breaking. In 2023, Zhongrong Trust, one of China's largest trust companies, suspended payments on dozens of investment products. Billions of yuan frozen. Investors who thought their money was safe suddenly couldn't access it. Protests erupted outside Zhongrong's offices. Angry investors demanding their money. Some had invested their life savings. Later that year, Highwind, a publicly listed wealth manager, revealed it couldn't meet client redemptions on time. The real estate products it had sold to clients had gone toxic. The underlying projects had failed. There was no money to give back. The dominoes are falling. Property developer troubles lead to shadow bank failures. Shadow bank failures lead to stress on small banks. Beijing is moving fast to contain the damage. Regulators have ordered dozens of shaky local banks to wind down their risky wealth management business entirely by 2026. The goal is to separate traditional banking from these high-yield, high-risk products that carried implicit guarantees. Authorities are also forcing consolidation, merging weak banks with stronger ones, injecting capital into institutions on the brink. But it may not be enough. If property prices keep falling and local governments keep struggling, more loans will sour beyond what banks have prepared for. In a worst-case scenario, multiple bank failures could occur simultaneously. That would trigger mass panic, a nation run on banks. Even short of total meltdown, a crippled banking sector chokes off credit to the economy. Small businesses can't get loans, families can't get mortgages, growth stalls. And that brings us to the final crisis. The entity that's supposed to stabilize everything, the government itself, is running out of money. For decades, local governments funded their budgets through a land sale bonanza. They'd sell land use rights to developers for massive fees. Need money for a new highway? Sell some land. Need a new hospital? Sell more land. It was a golden goose. That model fueled China's urbanization boom. It filled city coffers. Local officials could build infrastructure, fund public services, and still have money left over. But the property crash has annihilated that revenue stream. Land sales, which provided nearly 40% of local government income in 2021, have collapsed. By 2023, land-related revenue was down to just 27% of budgets, a massive drop. In 2024, local government sold only 4.9 trillion yuan worth of land, roughly half the annual take at the peak of the boom. The decline continued into 2025 as cash-strapped developers stopped bidding on new land entirely. Why buy land to build apartments nobody wants to buy? Without land revenue, local governments can't pay their bills, and the bills are enormous. Chinese local governments are responsible for about 85% of public spending. Education, healthcare, infrastructure, social services, public sector salaries, all of it falls on local budgets. Some cities have slashed public investment, projects halted mid-construction, roads left half-built. Others have delayed salaries for civil servants and teachers. In some regions, government employees have gone months without full pay. Still, others have raised fees and fines on residents just to scrape together funds. Traffic fines suddenly doubled. Business licensing fees skyrocketed. It's taxation by another name. And many local governments have borrowed heavily. Local government debt has swelled to 50 trillion won, much of it hidden in opaque, off-the-books financing vehicles. These are shell companies created by local governments to borrow money without it showing up on official balance sheets. The exact amount of this hidden debt is unknown, but estimates put it at 50 to 60 trillion won, maybe more. In poorer provinces like Guizhou, a mountainous region in southwest China, the debt situation is catastrophic. Debt repayments now exceed total revenues. The province literally spends more on interest and principal than it collects in taxes and fees. Guizhou is functionally insolvent. It's pleaded with Beijing for emergency bailout multiple times. The central government faces an impossible choice. It has long relied on local governments to drive growth and handle expenses like education, healthcare, and social services. But now Beijing may need to bail out entire provinces. The combined budget deficit of China's central and local governments hit record highs in 2024, officially around 8 to 9% of GDP. Unofficially, considering off-budget borrowing, the hole is even deeper. If multiple cities or provinces hit a financial wall at the same time, cascading defaults could shake the entire financial system. And when local governments can't deliver basic services, public trust evaporates. If salaries go unpaid, if schools close, if hospitals run out of supplies, discontent will explode. This is the final piece of the puzzle. 7 crises, all happening at once, all feeding on each other. The housing crash erodes wealth, killing consumer spending and hurting factories. The real estate collapse slashes local government revenues, worsening fiscal crises. Fiscal stress leads to defaults, hammering banks drowning in bad property loans. Banking strain chokes off credit, prolonging the industrial slowdown. The pension time bomb and demographic collapse drain government budgets and dampen optimism. Young people save more and spend less, deepening deflationary pressure. And the export slump means China can't export its way out this time. It's what Chinese economists are calling a resonance of disappointment, multiple crises reinforcing each other, shaking confidence at every level. Consumers won't spend because they worry about jobs. They worry about jobs because businesses struggle. Businesses struggle because banks won't lend and exports are down. And around it goes. Investors, domestic and foreign, are taking note. Capital is fleeing. The currency is weakening. For the Chinese Communist Party, this is the ultimate test. Social stability has always been the priority, the unspoken deal. Tolerate one-party rule and living standards will keep rising. But what happens when that promise collapses? We could see homeowners protesting at developer offices, retirees marching for pension payments, bank customers lining up in fear, factory workers striking over layoffs. Beijing has tools, censorship, surveillance, occasional concessions, but multi-front crises could overwhelm those mechanisms. A severe economic breakdown could morph into a political crisis. 2026 might be the year the 7 systems break together. Not one explosion, but a convergence of failures, each accelerating the next until something gives. So here's the question. Is this China's reckoning? Will Beijing pull off a miracle rescue? Or are we watching the beginning of a superpower's economic collapse? Let us know what you think in the comments and subscribe to Fall of Nations for more deep dives into the forces reshaping our world.